Hey guys, what is this? This is not your accounting videos that you're supposed to be watching. What is this? Come on, I'm gonna record a video on notes receivable. I want you to come watch it.
No.
Was that no, or is that short for notes receivable?
No.
You wanna watch the recording later when it's finished?
No.
Minnie, do you wanna watch a video on notes receivable? Yeah? Minnie, do you wanna watch a video on notes receivable? Yeah? Okay, we'll start in just a minute. I like the excitement. This video is on notes receivable. Remember that notes receivable are like accounts receivable, except that they are a formal instrument. Typically, there's an actual contract that needs to get signed, and in most situations, the borrower, the note receivable is from the perspective of the lender, and the borrower needs to pay interest. Let's start with a note. The first type of note that we're going to look at is a note issued at face value. Let's take an example of a 2-year note with a principal of $80,000. Principal is also referred to as the face value and the maturity value because this is the amount that must be repaid at the maturity date of the note. The note requires 6% interest to be paid annually, and the note was issued, meaning the money was lent out to the borrower, on September 1st, 2020. So we can see here that the note is going to have a maturity date of either August 31st or September 1st, 22, 2 years later. Interest is paid annually. And let's look at the journal entries that are required over the life of this 2-year note. First entry is going to be the note at issuance. Now, notes can be issued for one of two reasons. Either it's a company that provided goods or services to a customer, and in exchange, the customer didn't have the cash, so the company is acting as a lender as well. It provides the goods and then says, you can pay us, sign this contract, and you can pay us in 2 years, but you do need to pay annual interest on this note. Or the company that is issuing the note receivable, the lender, can be more like a bank where it's not providing any goods or services, but instead of the issuance of the note, it's giving out cash. So either of those two. So regardless, the debit on 9/1/2020, the debit is going to be to notes receivable. And then as we look across these examples of notes receivable, the credit at issuance can either be to cash or service revenue or sales revenue. In this case, let's say it was service revenue. Let's say goods were provided, and because the customer didn't have cash, a note receivable was issued. For the face value of the note, $80,000. Okay, so what's the next entry going to be in this problem? The next thing that happens is that interest would be paid annually. Now we need time to pass for interest to accrue. So interest is not going to be paid on September 1st. And so if you're thinking that perhaps the next entry should be on September 1st, 2021, you're almost there. We will have that entry, but there'll be one more journal entry before then. Can you guess which entry we should record before then if I give you the hint that that entry would be an adjusting entry on December 31st of the same year that the note was issued? Well, even though the interest hasn't yet been paid, interest is accrued. So on December 31st, the company is going to record an entry for interest receivable. Remember, these adjusting entries are to get the financial statements correct. When we debit interest receivable, our assets, specifically our current assets, increase, and we credit interest revenue. We want our income statement to show that even though we haven't received the cash related to the interest, we have earned interest revenue. For how long? How much is the amount? Well, we take the principal of $80,000. We multiply it by the interest rate of 6%, and we allocate, that would be for the entire year. We allocate this for the months that have passed between the date that the note has been issued and the last day of the year. So this note has been outstanding all of September, October, November, and December. So 4 out of the 12 months. And again, this 4 refers to September 1st through December 31st of 2020. Okay, so this is going to work out to be $1,600. So interest receivable goes up $1,600 and the income statement will report interest revenue of $1,600. What's the next journal entry that's going to take place? Well, the next thing that happens is on September 1st, 2021, the company is going to receive the cash interest payment from the borrower. So the company receives cash. Now, how much cash does the company receive? $80,000, the principal, times the interest rate, 6%. And then for the entire year, right? The note was issued exactly 1 year ago. Interest is accruing each moment that as time passes. And then that following year, 12 out of the 12 months have gone by. So 1 year's worth of interest, $4,800. How about the credit side to this? Well, one of our credit accounts is going to be for the interest revenue. How much interest revenue? Well, we have to think about how much was earned. The entire $4,800 has not been earned this year. Why not? Well, because on December 31st of 2020, we recorded the fact that 4 months of the interest had been earned. Now what we're doing is recording the revenue related to the remaining 8 months. So the principal of $80,000 times the 6% interest times the remaining 8 months out of the 12. Remember, the reason we have a denominator of 12 months is because our interest rate is on an annual basis. And these 8 months relate to January 1st of 2021 through September 1st of 2021. Those are the 8 months that have passed. And so this is going to work out to be the $4,800 minus the $1,600 that we've already recorded, so $3,200. And we need one more entry that's going to be for the remaining $1,600. Can you see what that entry is going to be? Well, on December 31st, we had debited to increase interest receivable. But what happened here on September 1st, 2021? We received that interest. So if we did nothing else, remember, interest receivable is a balance sheet account. So that would still be reported on the balance sheet if we did nothing else. But what is the actual receivable? It should be 0 because we've got the full 1 year's cash payment. So we need to take off this interest receivable that we booked on December 31st, 2020, make it down to have our interest receivable account be 0. So I'm going to credit interest receivable for $1,600, and now my equation balances. So what else happens after September 1st, 2021? Year end, about to issue the financial statements to our investors. Right before we prepare our financial statements, we need to record our adjusting entries. Account for the fact, once again, that the company has earned interest. Remember, this interest revenue was only through September 1st. By the time we're putting together our financial statements, we need to record the additional interest that has been earned between September 1st and December 31st. So I want to, once again, similar to how we did at the end of last year, debit interest receivable and credit interest revenue. And this is going to be for the $80,000 times the 6% times, just like we did last December 31st for 4 out of the 12 months. Again, these 4 months relate to September 1st, 2021 through 12/31/21. So again, our debit and our credit are each going to be for $1,600. What's the last entry that takes place on September 1st, 2022? That's the maturity date, right? We said the maturity date would be September 1st, 2022. What happens then? Well, 2 things happen. The customer returns the principal payment, the actual entire amount of the cash payment. The customer is going to return the full $80,000, and the customer is going to repay the last year of interest that it still owes. the company is going to record the additional interest revenue between December 31st, 2021 and September 1st, 2022. So let's do this as the receipt of the cash related to the principal of the note. Let's do that as a separate journal entry from the interest. Let's start first with our interest. Just like we had done in the prior year, we have our entry just related to the interest is going to be cash debit $4,800. Again, that's the principal of the note times the 6% times the full years, because the interest is paid once per year. I'm going to credit interest revenue because the last entry that was recorded to interest revenue was on December 31st, 2021. We need to accrue between December 31st, 2021 and September 1st, 2022. So interest revenue is $80,000 times 6% times 8 out of 12 months. Remember, those 8 months relate to January 1st, 2022 through September 1st, 2022. And so again, like we calculated last time, this comes to $3,200. Again, we want to remove the interest receivable because this is the settlement of the note, so nothing is to be received. Now remember, we're doing two separate entries, one related to the interest, and now we're going to do a separate entry related to the collection of that note receivable. So the company also receives the cash of $80,000, the face value or maturity value or principal of that note receivable, and the company takes off that note receivable off of the books. So when we debit the asset account notes receivable, we're removing that note receivable from the books. Obviously, these two entries here can be booked together as one for cash of $84,800, and then we would see our three accounts credited for the amounts that we have here. The reason I'm separating it into two is that's the way that you're going to do this on the homework. In our next example, we're going to look at what's called a zero interest bearing note receivable. Our next topic is zero interest bearing notes. The name of this topic is a little misleading because zero interest bearing doesn't mean that there's no interest in the note. It just means that there's no cash interest paid periodically over the life of the note. Here in our last example, we could see that at the end of each year, cash related to interest was paid. Now let's look at zero interest bearing notes. If you've ever seen companies selling furniture or cars saying you could buy it today for, let's say you can buy the car today for $22,000, or you can buy it for, you could pay us $24,000 for the car in 3 years' time. If there's a difference between the price a good is sold at today and the price that you would have to pay in the future, we know what that difference is too. Even if the company doesn't advertise the word, that difference is due to interest. And that's kind of what the interest-bearing note is like. We're selling goods or services today at one price, and the customer may not even know what the value would be if the customer would pay today. What the customer does know is in the future, when payment is due, there's a certain amount that customer has to repay. There's no periodic interest payments. So if the customer is not being careful, they might not realize that interest, or what we call implicit interest, has been built into the contract. So one thing to know about the zero interest bearing notes receivable is that cash is only received by the issuer of the note, or the company that has the note receivable on the books. Interest is only received at maturity. There are no periodic payments of interest along the way, which is different from the example that we saw with a typical note receivable issued at face value. So let's look at another example. Let's look at a 3-year note, $10,000 maturity value or principal. This is a zero interest bearing note. And we know that this note has a present value, or the value of goods or services that could be offered today, for a price of $10,000 to be received 3 years from now. That $10,000 to be received 3 years from now, the value of that today is $7,722. And if we wanted to be able to calculate that, we would, or if we wanted to calculate what the interest rate is that's implicit in this, that's going to turn 7722 into 10,000 in 3 years, in Excel, we can say, let's find the rate. And we put in all of our terms. I forget the order of the specific terms, so this might not be the correct order Excel asks, but it would ask for the present value, and the present value would be negative 7722. We're giving up 7722 today, and we have our number of periods of 3 years, and we're going to receive 10,000 in the future. And what this would return is what's called the implicit interest rate. Implicit because this might not be advertised to the borrower or to the customer who's buying goods that are today worth $77.22. The customer might not even know this is what the goods are worth today. All they know is I can get these goods or services, and in 3 years' time, I need to pay $10,000. The implicit interest rate built into this, or when we solved it in Excel, is going to come up to be 9%. Let's look at the journal entries that would be required for the issuer of the note receivable across the 3 years. Let's say this note was issued on December 31st, 12/31/2020. So of course our first entry is going to be on December 31st, 2020. The company issues the note receivable. And now we need to know at what amount are we going to record the note receivable? We see two different dollar amounts here, right? The present value of $77.22 and the maturity value or face value of $10,000. And we will always record the note receivable at the amount of cash that will be received at maturity, or maturity value or face value. So notes receivable increases by $10,000. We would see this in the long-term asset section. We know that either cash was given out if the company is acting like just a regular lender, like a bank, or it could be if services were provided, it could be service revenue. So cash or service revenue cash would decrease or service revenue would increase in the amount of what was given today. Either $77.22 was paid out or revenue services of $77.22 were provided. Now, what about this difference? We know that the difference represents the interest. That's what the issuer of the note or the seller of the services, this difference is the implicit interest. But we can't record this to interest revenue, this difference, because time hasn't passed. We can only record interest revenue as time passes and we are actually earning that interest. So we're going to record this difference to a new account that we haven't seen before called discount on notes receivable. And this discount, 10,000 minus 7,722, is going to be 2,278. So we booked everything to the discount account. We know that it represents interest. So what we're going to end up doing is taking this 2278 and recording it as interest as time passes. But we're not simply going to say divide this by the 3 years and allocate it evenly over time. That would be considered the straight line method. What most companies are going to use is actually accounting for the time value of money. If we just divided this by 3, we would say there's no interest on the interest. But the fact that the value of the dollar changes over these 3 years, we're going to account for that time value component there. So we're going to use what's called the effective interest method to allocate the 2278 across the 3 years. Before we get to that, the first thing I want to point out is how we would report this discount on notes receivable. So in 12/31/20, now this is not a journal entry. This is the only entry here. This is entry number 1. The 12/31/2020 balance sheet reports in the assets section, and this is a 3-year note, so it would be in the the long-term asset section. It would report notes receivable of $10,000 less the discount. So this discount account is another example of a contra asset. Lack of room, I'm just going to abbreviate this on notes receivable. So minus 2278. And we call this difference, the 7722, we call this the carrying value of the note. And that carrying value is going to change at the end of each year as we allocate some of this discount to each of the 3 years. It says, what are we carrying this note at on our books at year end or on our financial statements? So let me just write a note here that this is a contra asset account. Just like accumulated depreciation decreases the value of our plant, property, and equipment, the discount on the notes receivable carries a credit balance, and we can see that here, right? We increase the discount account with a credit, and it always decreases the notes receivable account. Okay, so it's year end. We've issued our income statement, nothing related to the note. We've issued our balance sheet with a note receivable less its discount. And then the next thing we want to know is the discount it's allocated across the 3-year period, the 3-year life of this note, or the maturity term, the term of maturity of the note. And we don't call it allocating, we say the discount is amortized. Or we can say the discount gets reduced. We allocate this 2278 across the period. The discount is amortized at the end of each accounting period as an adjusting entry. And as that discount gets amortized, so we're going to debit to decrease the discount. And the other side of that journal entry is going to be a credit to interest revenue. So interest revenue is increased, or I could use the word interest revenue is recognized. When we say recognize, we mean put onto the financial statements. So recorded interest revenue is recorded on that income statement. How do we calculate the amount? I said that it's not equal to 2278 divided by 3. We don't typically use the straight line method. The discount amortization using the effective interest rate method. Discount amortization is equal to the beginning carrying value. So the carrying value of that note receivable at the start of the accounting period times the implicit interest rate. Okay, so let's go back to our journal entries. December 31st, 2020 was the issuance of the note. We put it on the books. Nothing else happens. Remember, there's no periodic receipts of interest, but we still record interest. Even though we don't get a cash receipt of interest, we still record the interest revenue. We know that it's implicit, the difference between these two numbers. So let's now, the next year, 12/31/2021, we need an entry to recognize interest. This would be recorded again as an adjusting entry. And what account? So we know if we're going to recognize interest, we know our credit is going to be to interest revenue. what do you think we're going to debit? Well, what we're doing is we are trying to reduce this $22.78 over the life of the note. So it carries a credit balance, so I'm going to debit to decrease the discount. So I'm taking away the discount, remember, no cash receipt, and I'm recording the interest revenue. The next question is, how much is the interest revenue and the discount amortization? So remember, I take the beginning carrying value. So if we are in the fiscal year of 2021, beginning carrying value is the carrying value on January 1st, which we said is $77.22. Multiply that by the implicit interest rate, which for this example is 9%. And then how much time has that been outstanding? Well, we didn't record anything else during the year, so this is 1 year's worth of interest. So times 12 out of 12, or times 1, or we can just drop this whole term with the allocation for time. And $77.22 times 9% works out to be $695. That's the amount of interest revenue that would appear on the income statement. The next thing to think about is what would the balance sheet report for the carrying value of the note. So the carrying value on the 12/31/21 balance sheet, the carrying value of the note well, what did we do? We decreased the discount. So we took $22.78. If we had subtracted the $695 from the $22.78, we decreased the discount. So what happens to the carrying value? Is it going to go up or down? Well, when we decrease a negative number, what we're doing is we're adding. We're going to add $695 to the previous carrying value of $77.22. What we're doing is we're building, if you could think of this as a timeline, and this is time 0, the date that the note was issued. This is the end of year 1, the end of year 2, and the end of year 3. When the note was issued, it was worth, the present value of it was $77.22. We're going to increase that number until we get to the end of year 3, at which point the present value is how much? Or at time 3, the note is worth $10,000. So we're going to increase it by the amount of the discount amortization each period. So the carrying value is equal to the beginning carrying value, $77.22, plus, remember, we add, we don't subtract, we add the amount of the discount amortization, $695, and we get that the carrying value is $8,417. That's going to be the carrying value reported on the 12/31/21 balance sheet. And so when we do our next journal entry, so we had journal entry 1 up here. We have entry 2 here. The next entry is at the next year on 12/31/22. This is going to be entry 3. Again, we have debit to decrease the discount, a credit to record or increase the interest revenue. And the amount is not going to remain $695. It'll change each period because the beginning carrying value of the note changes each period. So what is the new, well, we calculated this new carrying value, so I can put one of two things here in this before I do times 9%. Remember, times 12 out of 12, we can just drop out that term. I can say 8417, the beginning carrying value, last period's ending carrying value. Or if I wanted to, maybe if I'm not tracking the carrying value all along the way, I could say 7722 plus 695. Either way is fine. And then when we calculate that, that will work out to be 758. Okay, so what is the carrying value on 12/31/22? The carrying value of the note receivable, well, it's the previous carrying value, 8417, and then we're going to add or subtract the 758. Remember, we're building up towards the $10,000 future value or maturity value. So we're going to add 758. And so our new carrying value at the end of 12/31 and the beginning of year 2023, the carrying value is 9175. All right, so now we're in the third year. What did we do here? We took, to plug in onto our timeline, 8417, this is the value at the end of year one. And we said that 9175 is the carrying value at year two. We know what we should get at the end of 2023, year three. It should get up to $10,000. Let's book that entry. So the entry on December 31st, 2023. Here we're going to have two entries actually. So let me say entries because the note is going to mature. But the first entry will be to amortize the remaining discount on the note receivable. And record the last interest revenue on this note. Okay, so two ways we could do this. We could say 7722 plus 695 plus the 758, or we can take last period's carrying value, our beginning carrying value, 9175, and multiply it by the interest rate of 9%, and we're going to get 826. Interest revenue of 826. And we can see that if we add 826, we're off by just $1, right? If we take the 9175 and add the 826, we're going to be off by $1. And that $1 is just simply due to rounding. That implicit interest rate must not be exactly 9%. It must be a little bit different. But don't worry if we're off by $1. As long as we're coming within $1 or two, we know that we're amortizing appropriately. What we would probably do in this example is just force our last amortization to be 825, or the amount that makes our discount, the carrying value of the note, to be exactly $10,000. And then, because this is the maturity date of the note, 12/31/2022, we need to take off the note, right? This is the one time the customer pays at maturity. The company receives the $10,000 cash in exchange for selling something that was worth $7,722 3 years ago, and we remove that notes receivable. And so now what's left on the company's books? Nothing. The note is gone, the cash has been received, and interest revenue has been allocated across the 3 years. I hope you enjoyed this video.